So I was kind of half joking. I was saying that we all realized during this period that Amazon is actually not really a consumer discretionary. It's more of a utility. I don't know that many households in America, middle-class households, can live without it, quite frankly. And not just because they're delivering things to your home, but because of the content and because of Amazon Web Services, which is why most businesses that are trying to operate remotely are able to. Between Amazon and Microsoft, I really don't know what this pandemic and stay-at-home order would look like in a universe where those things stopped functioning. So Amazon I own. The one I don't own is Netflix, but in hindsight, I should own it. And it's just incredible how they really only have had one big hit show this year. They've had some comebacks, things like Ozark, but the breakout that Tiger King was, it kind of dominated the conversation when no one can go to the movies, no one can go to concerts, and nobody really pays attention to network television anymore. So Netflix doesn't need 12 of those a year, one every month. They really need one or two to keep those subscription levels high. So that stock has absolutely broken out, is at a new high. And jokingly, I referred to it as a pharmaceutical. It's kind of the panacea that we all treated ourselves with to cope with the mass anxiety. So I should own Netflix. I don't. I'm not that smart. I am in Amazon. I wouldn't be surprised if they both continue to lead the market.
Yeah, and Netflix adding a little bit to its gains. And Steph, you know, if you look at the catalysts for one of the reasons why we are, in fact, up today and why you have been, I think, perhaps a little more optimistic than maybe some have been, it's this idea of the backstop. It's the backstop by the government. It's the backstop from the Fed. You have a new stock that you've added to your portfolio, and I think it plays into that whole idea of all of this being a game changer, even in an environment of so much uncertainty and so much pain in particular areas of the economy.
Yeah, I mean, you said at the top, Scott, that the tone is slowly changing from panic fear, from emergency Fed action and fiscal action to one of, okay, maybe we're going to start to reopen the economy. We don't know when, but we do know we have more tests. We have better tests. We know we are seeing an improvement in some states in terms of the virus numbers. So all of that is good. And so to me, it sounds like we are going to reopen the economy sooner rather than later. Is it May, June, July? I don't know, but it's not a year from now. And I think the market is anticipating that, and I think the market likes it because it's a little more clarity, just a little bit more, right? We still have a lot of unknowns out there. So one of the names is that I have been buying, and I've owned it in the past couple of years, but I haven't in a bit, was UPS. And the reason it just kind of stood out that it is yielding 4%, and it's still down about 15% on the year. And so I like the risk reward. The whole story on owning this stock at this particular point is not necessarily business fundamentals, but more on their strong free cash flow generation. They're going to generate $4.2 to $4.7 billion in free cash flow this year. Their dividend costs them $3.5 billion. They also have $5 billion on cash on the balance sheet. So this is exactly the kind of name that I have been upgrading to Pete's point on quality. That's what I have been doing all along. I've been buying on yield, and I have also, as you know, nibbled a little bit on the cyclical side. And this is a kind of a cross between the two.